Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and I'm starting off with the S&P ETF, aka the Spiders. It's ticker symbol SPY. And if you've been following along over the last couple of weeks, you'll know that we've had a little bit of a change in the way I'm presenting, because each and every time the market has been ratcheting up, I'm showing folks how to move their support levels up in an effort to trail the stop. And as you can see right here, last week I had the support level right there. And if you look a little bit more closely, you can see that today's candle is red, but towards the end of the day and right up until the last minute, this was a solid red candle. And what happened is, in the last minutes of trading, and I'll show you the minute by minute chart, in the last minutes of trading, you can see that we had a big spike. A lot of that driven by Tesla, because Tesla is being added to the index, and in the final minutes, the fund managers get in, they buy it, they rebalance and such, and that caused a little bit of a bounce into the last minutes of the close there. Now, what does that have to do with next week? Well, if you look here, this moving average, that blue line, becomes the new support level as we ratchet up. You can see how the moving average has been acting as a support level. So as the markets become more overextended, we're going to ratchet that stop right up. So we're going to draw a horizontal flat line right at that moving average. And if you have any S&P stocks, you're going to look at the charts very similar to what I'm looking at now. You're going to find that moving average, move your stop up to just below that moving average. Therefore, if the market starts to drop below the moving average, what's going to happen? Most likely, it will now begin that downward trend that we've been looking for. Notice down here, that big spike in volume, again, a lot of it is because of Tesla and the final actions of the market. But notice that CCI and the stochastics is going lower. CCI actually today crossed with the sell signal. Now again, we're focusing on that new higher support level. We still have gaps below the market down here that I think eventually will fill. Only time will tell with that, but 80% of the time gaps fill. So keep an eye on that support level. I'm just going to keep moving that up. Once those support levels start breaking, I can now put some price targets down to the downside. But let me show you what's happening with the Qs. Again, this is a tech sector. You can see that we're still holding this fan line here. This is a fan line. I'm going to raise all these lines, and I'm going to show you the new extended and more vertical fan line right here. You can see this is the new trend, at least for the short term. Now, unlike the S&P, we had a bearish engulfing pattern show up here on the Qs. So I do think that next week we're going to pull back to at least test this support level or trend line. And then if you want to put hard stops and trailing your stops up, there's your moving average. Again, that moving average is right around 302.49. So trail your stop up. And again, look at the oscillator. So we're getting a lot of mixed signals, which makes me question how much longer this uptrend or up leg is going to last. As we come into the final days of 2020, a lot of times the last 5 days, known as the Santa Claus rally, we might see that. But historically, if we don't get the last 5 trading days of the month in successively higher closes, that could signal a bear market in the future. Go back and look at the Santa Claus rallies over time. 5 days in a row. That's what the real Santa Claus rally is. It's not the November rally into the beginning of December. It's the last 5 days. So keep an eye on that. Okay, that's the Qs. If we look at the VIX now, hopping around to the VIX, you can see that we made an attempt to go up. But last week I said we would pull back first before going higher. So we're still in this progression of a pivot point. I'm going to hold that because notice what happened down here to the CCI. CCI turned higher. Last week I said it would turn down. It did that. Now it's starting to pivot up. So we could be right at that point where we start to rally in the VIX. Next week, and the week after that. If the VIX continues to go higher, obviously that's more bearish for the markets. If I look at the IWM, which is the ETF for the Russell 2000, this one's still on a tear. We are now at the upper end of that broadening top right there with a red candle. Oscillators are pointing lower. I'm going to move this roll reversal up just a hair. Let me move this. I'm going to erase this and move that up so that you can trail your stop there as well. Again, we're using that 20-period moving average as a guide to manage risk. As it goes higher, we keep ratcheting it up, and we let the market tell us when it's time to go down. So once you get stopped out, you're moved to cash, and then you have buying power to participate in either short strategies, or you can trade options if that's what you want to do, and you'll have buying power freed up. If you don't put a stop and it drops, then you have nothing else to do except sell at a loss, or you're giving back a lot of your profits. All right, again, this is higher highs on the IWM, but notice this. I talk about the divergences all the time. We have a negative divergence on that CCI. Again, higher price highs followed by lower CCI highs right there. Let's hop to the diamonds. DIA is the ticker symbol. This is the Dow Jones Industrial Average for the ETF. And I'm going to move that stop up as well. I'm just going to erase this and move it on over. That's all we're going to do. We're going to move that up to a 20-period moving average. Towards the end of the day, right towards the end, it looked as though we were going to close below that 20-period moving average. And that too did a head fake. We rallied in the last 5 minutes pretty significantly. And this big red candle, as I magnify that, that was a big fat red candle right up until about 5 minutes before the close, and then it formed this shadow as it rallied. Again, once these support levels start to break, we still have a gap down here below that market. Now I'm going to hop back because I'm going to talk about this every single month and every single week and every single day if I can with our clients. If you go back and look at a monthly chart going back 20 some odd years, check this out. I'm going to zoom in just a little bit and show you. See this megaphone top? Well, that's not the first time we've seen that. Back in 2000, right before the Y2K crash, we had a very similar topping pattern. That was a broadening top, megaphone top. What happened? Boom, that's what happened. We dropped 45% over a 3-year period. And notice down here, I'm going to magnify this for you. See how dramatic the CCI has been dropping on the highs? Well, we had higher highs, just like we have now, but lower highs on the CCI. Let's fast forward. I was talking about this with a couple of clients I was coaching today. Here's another broadening top. You see this? What happened when it broke out below that pattern? Bam! The market dropped 50% from this high. 50% in 1 year. So see how the drops are accelerating? We'll look down below. The negative divergence on the CCI was very pronounced. As we continued to go up and reach higher highs, the CCI was showing lower highs. It gave us a couple of months before the year ended to get out, and a lot of people didn't. A lot of people held on. Well, guess what? I made money, and a lot of people that are following my strategies made money in 2008 because they shorted the market and took put spreads on at that particular point in time. As I go on, you'll see higher highs right here, lower highs on the CCI. People forgot about 2011 and into 2012. It's like a little blip on the radar, right? Well, guess what? Look at that. The CCI gave us the leading indicator. Fast forward to today, this is the most significant broadening top, megaphone top I've seen in 40 years. But what really stands out is that the divergence started a couple of years ago. You see this? 2018, the divergence started with lower highs until we see this right now. You see that? We have a lower high on a higher high for the month, and notice the volume dropping. All right, this is why I am consistently showing people how to start to get out of some of their buy ideas. I'm not telling you not to buy more on stocks that are showing the technical signals, but what I'm telling you is if you decide to buy, you had better make sure you're putting stops in, because if this market breaks out to the downside, then you could wind up suffering a catastrophic loss. And I don't want that to happen to anyone. Notice something. If the market just pulls back to the 20-month moving average, see, that's a 20-month moving average because I'm measuring periods. That's a 3,000 point drop just back down to the moving average. So I'm talking about there, and on lower volume, these tops become weaker and weaker as we go along. So keep that in mind. If you'd like, please subscribe, and I'm going to ask you a favor. Once you subscribe, hit the like button. Please do that. You're helping us get these videos out to people who need it. The more you like it, the more it's shared. And if you like, hit the notification bell. It's right there next to the subscribe button and the like button, and that will be sent to you as soon as this video goes out. You'll get a text message and you will be notified, and you'll be able to watch it right away. All right, so have a great weekend, and we'll talk to you next week. So long.